So we're going to get right to it, but we have Linda Svihovec for the Association of Counties. She's going to step-by-step cap calculation review and discussion. So let's give Linda a round of applause.
Good afternoon. Thanks for sticking around. Can I see a show of hands of just business managers, county auditors, and city auditors? All right, that's who I was hoping would be here today. Thank you for being here. I was listening to a podcast this weekend, and it was a quote I wanted to repeat. Just to give you a little background, the quote is, "You don't get thank you notes for things that don't happen." And it was meant in a positive light. I wanted to say that your member association leaders, your executive directors, and their lobbyist teams worked really, really hard on this bill, House Bill 1176. And there was a lot of things proposed throughout the session that would have made what I call the 69th legislative session's big, beautiful bill. This is their version of a big, beautiful bill. And it could have been a whole lot worse. So when we say you don't get thank you notes for things that don't happen, sometimes not getting a thank you note because something didn't happen is okay. We are, okay, I can see it. We are going to do some very boring, somebody said earlier, this is boring stuff. We're really literally going to walk through math calculations here in the next hour. And please jot down notes. This is not going to make sense to everybody if you don't do this work every day and if you don't talk about these numbers every day. But we really want to make sure if you have questions and we want you at a comfort level, we want to make sure we get those answered. So, House Bill 1176, 69th legislature passed it, a vote of yeas of 132 and only 4 nays. And this was on the final day, I believe, of the session. So if there was a conception out there that somehow we weren't going to have caps at the end of this legislative session, I'm not sure that that vote would support that statement. I think it was kind of inevitable. It did pass or approve a $1,600 tax credit for primary residences. This last year it was $500. They increased that to $1,600. It does cap local government at a 3% growth in dollars levied. We're going to walk through that calculation. And it does allow for unused percentage increase to be carried forward for up to 5 years. And we'll actually walk through what that might look like and a calculation for that as well. Taxing districts are also able to opt out by a majority vote at a general election. So only at a general election, but majority, not a supermajority, so 50 plus 1. We're going to specifically talk about Section 22 in House Bill 1176, and that section is deals with and is titled The Limitations on Levies Without Voter Approval. Property taxes levied in dollars, and this is direct quote from Section 22 in the very first paragraph. Property taxes levied in dollars may not exceed, and here's the key word, the greater of the base year levy increased by the allowable percentage limit or the adjusted year levy increased by the allowable percentage limit. So you're going to have to run 2 calculations to determine which is the greater. What is the allowable percentage limit? In House Bill 1176, that is 3%. Home Rule Authority may not supersede the cap. That's in the bill as well. The unused excess percentage increase, it can be used in any of the 5 succeeding taxable years. It can only be used once, and it may not carry forward beyond 5 taxable years, and you must use the oldest unused excess percentage increase first. For some reason, I had the hardest time with this concept, and thank goodness Danelle put together this little graphic for me to help walk me through it so I could visualize how this would be. So the example is year 1, you actually need a 1% increase. So the excess, you're leaving 2% on the table to be carried forward to the next year. Year 2, you need 2%. So that leaves 1% left unused to carry forward to previous years. And it's a rolling balance, so it accumulates. So the total between year 1 and year 2 is a 3% that you can carry forward to previous years. Year 3, you're going to need 5%. You're going to use the 3 you're allowed plus 2 of those carry forward percentages. And that leaves you a 1% balance, and so on. So this visual was very helpful to me, hopefully helpful to you as well. And we'll talk about how you calculate that unused percentage in a future slide. Okay, a big part of calculating the cap is understanding how many levies are exempt from being capped. And I will just say generally, anything related to debt payment, and we'll walk through the list, but anything related to debt payment, anything related to special assessments, whether it's special assessments on your political subdivision or special assessments that you're paying and collecting from constituents. Anything you levy related to special assessments is exempt from the cap. And any dollars you have levied to pay for debt are also exempt from the cap, and some others. So we'll walk through that list, and there's 3 or 4 pages here. So the first is any new or increased levy authority by either a change in state law, which there was none in this last session, but it has happened. Not for a long time, but it has happened, or any new or increased levy authority approved by voters. So not approved by voters the last election cycle, but approved by voters going forward. So an example of that is there's a county that their voters approved 20 additional mills for their county road. So for a total of 10 are allowed with counties. And their voters approved an additional 20. So they have 30 total mill levy allowance in their county. Their board, being responsible and conscientious, only put 25 mills on last year. Can they go directly to that 30 because the voter approved it? No. The base year was established when they put that last year's is the basis for the 3% cap. So you can't automatically hop to the 30 mills because your voters approved it 2 years ago or last year. Secondly, levy authority increased above 0 mills in the previous year. Okay, it doesn't read exactly like that in the bill. We asked for clarification. Every legislator we talked to, and I think the tax department's in agreement that the way it's worded can make it feel like it says if it wasn't used previously, I believe is how it's worded. The intent of the bill and the interpretation of the bill is if you're at 0 mills the previous year and you have levy authority to go beyond that, those new mills that you're going to use beyond 0 are not capped. Once you put the mills on, going forward, they're subject to the 3% cap. The next one on the list is levies to pay bonded debt. Again, I referenced earlier, anything related to debt. The state medical center is exempt from the caps. They are the only levy authority in all of statute that mandates a mill levy, and it's 1 mill. Everybody else is a not to exceed levy authority. Garrison diversion is exempt from the cap, not to exceed 1 mill. Taxes or special assessments to pay obligations, including for special assessment deficiencies, are not subject to the cap. Taxes levied to pay bonds, evidence of indebtedness, including under Century Code 57-47 by the Bank of North Dakota from the Infrastructure Revolving Loan Fund. Those levies, those dollars are not subject to the cap. Taxes levied for the cost of a special improvement project are not subject to the cap. And then under one section is a whole bunch of levies listed by Century Code, and this is that list, interpretation of what the Century Code means. The additional levies exempt from the cap are this: city special assessments under 40-2410, city judgments or settlements of claim under 404301, the county emergency levy under 571528, tax levies for payment of special assessments, again, there's that special assessments under 571541, the city emergency levy under 571548, levies for the operation of water resource districts in the whole chapter of 61-16.1. So anything related to water resource districts are not subject to the cap. And taxes levied by a school district for tuition under 5715-14.2 are not subject to the cap. And then lastly, Stephanie was very determined that these two little levies that are expiring this year, they're just related to cities. These two, one time only, animal shelters and fire department buildings or equipment reserve fund are exempt from the cap. They are to be added to the general fund for 2020, this tax year 2025 in an amount equal to what was levied in 2024, and they will be included with the 2025 general fund levy, and that portion will be exempt from the cap for those two levies. And there were only a couple cities, I believe, that were actually utilizing those. Okay, like I mentioned earlier, we have the option to opt out of caps with voter approval. The majority of voters at a statewide general election only. It's good for up to 4 taxable years, and the ballot measure must state the proposed percentage increase exceeding the limitation and the proposed dollar amount of the increase exceeding the limitation. So again, it's good for 4 taxable years, and there's no limit on what you can ask your voters to approve as an opt-out. This was an option that was not in the original bill that was asked for, and I think it was Aaron Burst's idea, if I don't remember. Just give my boss a little credit. Specifically townships. Existing law stays the same regarding township levy limitations, and that is that electors approve levies at an annual meeting in the month of March. The general fund levy cannot exceed 18 mills, except unless the majority of electors at a township meeting approve an allowance of an additional 18 mills. And that meeting notice must include the question to approve the additional mills, and that is good for the additional mills, so a total of up to 36 are allowed for 5 taxable years. You certify the levy to the county auditor within 10 days after the meeting, and that's under 57-1532. So again, nothing about that and the current practice for townships has changed. However, townships also have the ability to opt out of the caps. And same thing applies. It has to be approved by the majority of electors at their annual meeting. So they don't have to wait for a general election. They have an annual meeting. Their electors can vote at their annual meeting to opt out. It's good for 4 taxable years, like everyone else. And the annual meeting notice must contain those 2 elements, the proposed percentage increase and the amount of increase to exceed the cap. Now we're going to get into the math. Cap calculations, we're going to talk about the maximum levy authority and the percentage increase. So levy authority, nothing has changed regarding existing levy limitations. And that probably sounds ridiculous when we know we have caps. But every levy limitation, 60 mills in a county general fund, 105 in a city general fund, those levy limitations that are established by law still exist. Caps, however, provide for a maximum amount of that a taxing district may levy in property taxes. So it sets a cap to what you can levy, but it doesn't give you authority to go over a maximum mill levy limitation that exists in law. So it doesn't automatically erase all the other levy limitations. And I hope I can explain that clear, because I didn't understand that initially with this bill. So you have all the levy limitations, but if you're at 60 mills in your county general fund and 3% puts you at 62 mills, you can't do that. You can go 3% overall in the dollars you're levying, but that 60 mill levy limitation still applies. Each taxing district is responsible for calculating their own cap and determining the amount of dollars to levy, like you've always done. All existing levy limitations apply. Taxing districts will certify their levy to the county auditors no later than October 10th, like you've always done. County auditors will run the maximum levy worksheets for every levy and every taxing district in the county based on the levy certified by the taxing district. So to answer a question I've been asked frequently, sometimes by a county auditor and sometimes by others, who's responsible for determining whether my city calculated the cap correctly? You are. Not your county auditor. They're not going to run a cap calculation on every political subdivision in their county. So it's good that you're here. It's good that you're listening online because you will be responsible for that portion of your calculation. So we talked a little bit early about may not exceed the greater of. So for caps, there are two calculations. You're going to do a base year calculation and an adjusted year calculation, and we will walk specifically through each of those. So again, the base year levy increased by the allowable percentage, or the adjusted year. It's the greater of those two. And you have to run both calculations to determine which is greater. I've run into one of probably a dozen scenarios that I either asked for from some of you or just ran based on the numbers I could find historically. And all but one, the numbers were different. So there was something greater. One was greater than the other. One, because they actually reported no new growth. The calculation was the same. So definitions. What is the base year levy? The base year levy is the highest amount of property tax dollars levied in the previous 3 preceding years. Very simple. What did I levy last year, 2 years ago, 3 years ago? Your adjusted year levy is the amount of property tax levied in dollars by a taxing district in the preceding year or last year. Adjusted as follows. You're going to add in new property. You're going to add in any expired exemptions, the taxable values for these. You're going to subtract any property removed. And you're going to subtract any expired temporary mill levy dollars, amount in dollars. I haven't seen one scenario anywhere in the data that we've got anybody that has an expired temporary mill levy, but it's in the law, so we've allowed for that calculation in the calculation worksheet. So the difference, base year is the highest of the 3 preceding years. Adjusted year is the preceding year with adjustments for new growth. So you don't get to take the growth calculation on the base year calculation. That is just strictly going to look at those 3 years. What did you levy? And then the adjusted year levy. And now the fun begins. I think you guys have handouts on your desk, on your tabletops, and it might help. I don't know how, wherever it's easier for you to see, but we will, I apologize in advance, but we are going to walk through this line by line because I don't know how else, if I was learning this, I don't know how else I could generally explain it without walking through it. So the worksheet that we have prepared works for everybody. You're not required to use this worksheet. We'll provide it to you in an Excel format. It's got some protected cells, in it as well, but it does all the calculations for you. If you plug in anything that's in the blue boxes, it will run all the other calculations for you. You're not required to. If you've got there's more than one way to come up with this calculation and get these numbers. So if you've got another format or your finance director, somebody's already come up with another format, feel free to use it. This is a tool for those who haven't developed or don't have a form created. So we're going to do calculation 1. We're going to do that base year calculation. And on line 1, we're going to list and call it the 3 columns for, and I specifically put this as tax year 24, tax year 23, and tax year 22, because the tax year always lags 1 year behind the budget year. So we're going to look at the previous year levy, which is 24, 2 years ago, 23, and 3 years ago, 22. We're going to have you list the total, on line 1, the total dollars levied on behalf of the taxing district. On line 2 through 11, only those lines that apply to your political subdivision and your taxing district will you fill out. These are the levies that are exempt from the cap. So we're going to subtract those out of those total dollars you levied. On line 12, it's going to calculate that difference. What are the total dollars you levied less a sum of lines 2 through 11? Line 13 then is going to look at the numbers in line 12 and determine which is the highest of the last 3 years. And it's going to plug that number in for you. Line 14 is going to calculate 3% because that is now your base year. And it could be, oh, it doesn't fit on here. Follow your sheets. It doesn't fit on here. Or at least it got cut off when it got printed. Oh, sorry about that. Oh, that's what it is. Okay, that's right. Thanks for helping me through these slides. All right, that's right. This slide is a demonstration of a political subdivision that actually provided me some numbers, including what they're thinking about budgeting this next year. So I just have on this slide an example of what this might look like. This happens to be a school district. They entered into the line 1, the three preceding years, the total dollars they levied. They subtracted out on line 6A the specials on school property. If I remember, that's what the levy was. And on line 7, they subtracted out their tuition levy. And it left them with, on line 12, a net difference of 8.7 million, 8.3 million, and 7.7 million over the last 3 years. So finishing off this calculation, Matt, thank you. Next slide. Lines 12 through 15 do this. They calculate that difference, and it determines which year on line 13 is your base year. And it could be any one of those 3, depending on how your levies have fallen. It calculates 3% of that base year levy. So in this case, it's the 8.7 million, and 3% of the base year levy is 261,000. And it adds that to the 8.7 million. So in this case, the base year levy, adjusted by 3%, is a total of $8,965,000. So that's calculation 1. That's what the base year is. It's the base year, determining what the base year is, adding 3% to it, and that's the base year adjusted by 3%. Calculation 2 is the adjusted year calculation. It's going to pull on line 16 the previous year levy from the numbers you entered on the calculation 1. You have to enter the previous year taxable value. So you're going to have to get that, and I'll share a couple of resources from you, but definitely your tax director would have it if your finance or business office doesn't have it. You can get it from the tax department's tax levy lookup tool, and I'll show you where to find that on the website at the end of the presentation here. And then it's going to do those adjustments on lines 19 through 22. You're going to enter numbers you get from your tax director. You're going to enter the new growth number on the new property value, taxable value on line 19. If you have, and I don't know if that was clear to you all, if you have an expired TIF, that incremental value that you have not had access to in your taxing district because it's been set aside to pay down that TIF, once that TIF expires, your tax director will be able to provide you, and you'll be able to put that value in as an add-on. Line 21 is also any exemptions from the prior year that have expired. And then line 22 is any property removed since the prior year. And you're going to enter taxable values of those. Again, those are numbers. If you don't have them, you won't have these because these are based on the new year, since last year. So these are numbers you're going to get from your tax director. And again, likely not until end of June and then with centrally assessed, it would be end of July. So calculation 23 then takes line 19, which was the new property taxable value, plus line 20, plus line 21, minus line 22, and it's going to come up with, it's going to calculate for you a net increase of taxable value that you get to add on for this next year. It's going to calculate the calculated mill rate from the previous year, and I'm sorry, this is complicated. County auditors are like, yeah, I get this, it makes sense. It looks very much like their maximum levy worksheets, but for those of you that don't run this, trust the formula. If you enter the right numbers, it'll do these calculations for you. But it's going to calculate that new growth allowance times the previous year mill rate and equivalent that to a dollar amount that you get to add to the previous year's levy. And so that is on line 26, that is the net adjustment. Line 24 plus line 25, well, that's with the expired growth. Line 27 is the adjusted year levy. It's line 16 plus line 26 because, like I said earlier, I haven't run into one expired temporary mill levy yet. But if you are, you'll have the ability to enter that, and the worksheet allows for it. So on line 27, you're going to get your adjusted year levy. Line 28 calculates 3% of that levy, and line 29 adds that 3% adjustment to the adjusted year levy and gives you a total amount of the adjusted year levy increased by 3%. And here's the example of that calculation. This is that same school district. It pulled that previous year levy from line 12 on the calculation 1. That's $8.7 million. Their previous year taxable value was the year that was used to calculate the previous year mill rate. And then line 18 calculates that mill rate by taking line 16 divided by line 17 times 1,000, and 92 mills it was. And then lines 19 through 22 are their adjustments for new growth on line 19 and property removed on line 22. Line 23 takes the difference between those two. So line 19 minus line 22. So it's $1,037,000 of new growth value allowance. It applies that 92 mill rate, those 92 mills from line 18, and it calculates a dollar equivalent that you get to add to the previous year or the preceding year of $95,421. So that's under this adjusted year calculation, that's the additional dollars you're going to be allowed to levy over the preceding year. So line 27 is your adjusted year levy, which is line 16 plus line 26. That's the previous year's levy plus that adjusted year levy. It is line 28 is the 3% adjustment to that, which is $263,000. And line 29 gives you your adjusted year levy increased by 3%. So last year you levied at the very top on line 16, you levied $8.7 million. This year with your new growth, you're going to be allowed to levy under the adjusted year levy $9,063,000. So the formula we'll look at it, the worksheet we'll look at, we're going to go back to the base year dollar allowance increased by 3% was $8,965,000. That's from line 15. Line 29 is the adjusted year levy increased by 3%. That's $9,063,000. It's going to automatically, on line 30, select the higher of those two and tell you what's the max dollars you can levy. $9,063,327. Now, obviously, both in base year and in the base year and in the adjust year calculation, we subtract out anything that any levy that's exempt from the caps. So this is also, this maximum is the maximum dollars you can levy in all of the levies except those that are exempt from the cap, that long list of exemptions. So separately, you're going to still run and calculate in your budget and determine what you need in those levies that are exempt from the cap, and those are in addition and above these dollars. Does that make sense? That these dollars in this calculation only apply to the levies that are subject to the cap. Separately, you will still calculate and run and levy for any levy that is not subject to the cap. And those are in addition to those dollars. Have I lost everybody? I'm looking at the auditor to see if it makes sense. Okay, I got thumbs up from one. Okay, the last calculation on the worksheet is calculation 3, which calculates the excess percentage increase for future periods. Line 31 takes the tax year 20. How many dollars, capped dollars, not all of the levies, but how many capped dollars do you intend to levy for this next year, for tax year 25? You're going to enter that in line 31. Line 32 through 43 is any levies that are exempt from the cap. So the total dollars you're going to levy, I think I might have said that wrong in the first, but the total dollars you're going to levy go on line 31. Anything exempt from the cap, you will subtract out in lines 31 through 43. And line 44 will calculate the difference of that total on line 31, less all of those levies that are exempt from the cap, and that's line 44. It'll calculate an unused cap amount, and it does the calculation based on whether you used whether the higher was the base year levy or the adjusted year levy. It will calculate that for you. And it will calculate a percentage based on which one of those you use, that is a minimum of 0% and a maximum of 3%. So here's what calculation 3 looks like for this school district. Their total dollars they plan on levying for tax year 2025 for their 2026 budget is $9,962,000. Again, this school district levies for special assessments on school property on line 38A. So there's $285,000 they anticipate for that. And on line 39, they are subtracting out what they anticipate levying of that total for tuition. And on line 44, it gives them a net of $8,988,000. This is for the calculation of the unused percentage, which means, let me see if I can go back. Can I go back one? I can't go back. One more. I don't know what I'm pointing at. Oh, okay, that works. So they were eligible for $9,063,000. When you do the calculation on the unused cap calculation 3, they're only going to be levying $8,988,000. So I don't want to say leaving it on the table. There's $74,594 of unused cap increase allowance. That calculates out to 0.85%. They can carry that 0.85% forward for the next 5 years. Next steps. You're going to complete a separate cap calculation worksheet for any levies that are not applied entity-wide. So an example is an ambulance district, unorganized township roads, vector control. There might be others. Some airports only apply to certain levies and not, or certain values, certain properties, and not others in your political subdivision. So you're going to have to know which ones apply countywide, that's natural for me to say, entity-wide, and that taxable value applies to all of the taxable value in your taxing district. For anything that applies to less than your total taxable value in your taxing district, you'll have to run a separate cap calculation worksheet for that, for any of those. You're going to review your proposed levies for your preliminary budget, You're going to verify that the amount of levy falls within that cap allowance. And all existing reporting requirements and deadlines still apply, except political subdivisions under House Bill 1176 no longer provide preliminary budgets and a certified levy to the county auditor by August, it says first, by August 10th. You've done that since 2017, I believe, because House Bill 1176 eliminated the estimated notice that goes out in August and replaced it with a budget hearing notice. So you do not need to provide the county auditor with your preliminary budget or your certified levy in August any longer. The next slide for House Bill 1176 will go through the budget hearing notice. So that was replaced instead with the language requires on or before August 10th. A preliminary budget statement is to be prepared by the governing body. So I had a question on a webinar I did for counties a couple weeks ago, and they said, where does it say when counties have to have it done? This statement is what we were told applies to all taxing districts. And the statement in the bill reads, preliminary budget statement is prepared by the governing body, that's all governing bodies, by August 10th. A public budget hearing date is set by August 10th, and it can't be any sooner than September 7th and no later than October 7th. Political subdivisions will provide to the county auditor a notice of the public hearing date, the time and location of the budget hearing, and where the budget can be reviewed. And that is to be provided to them now by August 10th. You do not need to provide your preliminary budget or your certified levy by August 10th, but you do need to provide the budget hearing information. And this is the two sections of code that I'd like to share with everybody whenever I have an opportunity. You still are required, though, to provide the county auditor with your certified levy by October 10th. So as it says here, no taxing district may certify any taxes or amend its current budget, and no county auditor may accept a certification of taxes or amended budget after the 10th day of October of each year, if such certification or amendment results in a change in the amount of tax levied. The current budget, except for property taxes, may be amended during the year for any revenues and appropriations not anticipated. The exception to that, and this has not changed that I'm aware of, Adam, is in 57, 15, 13 school districts, because of that funding formula, are allowed to, they may increase or decrease their levies up to October 10th. So for all other political subdivisions, what you approve in your preliminary budget is the maximum you can spend and the maximum you can levy in taxes. School districts can actually increase it because you heard today those values fluctuate a bit. They're allowed to try to get to that full 60 mils the best way they possibly can, and so they have to take advantage of the true, real, actual value. So that's one little thing. So links and resources. There's my friend in the back. A very important one, the North Dakota Levy Limitation Schedule. Can we click on that first link? Okay, and just kind of scroll down to the middle of the page here. If you're not familiar with this will be updated by the tax department. Every odd year after the legislative session ends, the tax department updates this publication. This publication contains the levy authority for every single political subdivision in the state. It tells you what levies are available to you. It tells you exactly whether or not you need to have a vote to utilize those levies, or it's your board's authority. You're going to want to really be familiar with this publication if you aren't already. The second link is the tax department's tax levy lookup tool, which is where I have pulled almost all of the data to prepare and create scenarios to prepare for today's presentation. if you would click, oh no, this is maximum levy worksheets. I'm sorry. I saw it say tax department. Maximum levy worksheets. If you would click on the first line there, the plus sign to the right. Yep, of maximum levy worksheets, correct. There's a list of the maximum levy worksheets. These will also be updated by the tax department very shortly here. So you'll have the most current ones. I can tell you that I don't think a lot has changed on them, if anything, that I'm aware of. So if you're trying to get ahead of the game here, you can definitely look at that. But these are the sheets that the county auditors fill out for every single political subdivision, every taxing district in their county. And this is where the actual mill rate is calculated that gets input into their tax system and gets applied to the valuations. Okay, the last link is the tax department's tax levy lookup tool. Okay, scroll. The link will take you to the State Board of Equalization page. My understanding is that the tax department is updating their website, and this might move. I'm a little worried about that, but this is where it is as of now, and it's not easy to find, so it'd be nice if it moved to a more convenient place, but we all need to know where you move it to. So if you scroll to the bottom of the tax equalization page, the top thing says tax levy lookup tool. Go ahead and click that. And it's going to bring you to this screen where you can select 1 year or multiple years. I believe there is a history of data, tax levy data, back to 2015 or 16 for every single political subdivision. And you can look at it for all schools. You can look at it for a particular school. You can look at it for 1 or 2. I think you can compare up to 2 years, or you can look at all the years. And then you can export that data into an Excel spreadsheet and use it however you want to use it. I bet there's hardly a day goes by that I don't access that. So that link will be provided. It's on the last page of this handout as well. So with that is the end of my presentation. But boy, oh boy, I'm sure looking forward to questions. From everyone except Erica. I know.
2 clarifying questions first, Linda. Thank you for the information today. The first one, the levy authority for above 0 mills. So if I have 0 mills in my county extension fund for this year, next year I could go to 2 mills. If I went back to 0 in the following year, would I be able to go to the full 2 mills after that? It's just the preceding year, correct? It's not since this year.
That's a great question, and we've been asked that a number of ways, and I can't wait for the attorney panel to get up here to see those executive directors to see how they answer this. Theoretically, yes. If you go back to 0, you can go up to whatever the maximum levy authority is under the limitation schedule. And if you go back to 0 the following year, you can go up to the maximum again after that.
Second clarifying question, townships are the only taxing district that can opt out. Every other taxing district is subject to the caps, correct?
No, that is not correct. Every political subdivision has the ability to go to a vote of the people to opt out. Townships, however, unless they're planning on exceeding their levy authority and by 3%, they don't need to wait till a general election or go to a general election, because they have a vote every single year. So they can, at their annual meeting, they can vote. They don't have to wait till the general election.
So the fire district annual meeting, they can't opt out. They would have to go to a vote at a general election.
They also convene their members at an annual meeting, I believe. Here's what I'll say, because I don't want to misspeak. If you vote on your levies at an annual meeting, if your electors vote on your levies at an annual meeting, you would have the ability to vote at that annual meeting to opt out. You would not need to wait till the general election. But if you're a fire district and electors aren't gathered together once a year, or any other political subdivision, and I'm not certain on which ones are besides townships. Townships are the only one that are called out specifically in the bill. So if you're a political subdivision that brings your electors together at an annual meeting, you could use the annual meeting to do the opt-out vote, is what I'm saying. If fire districts don't bring their electors together annually to vote on levies or any other political subdivision, they would have to have it at a general election.
And then the third question, which may be the most challenging of my questions anyway. What is the remedy, since the county auditors are not policing the cap calculation, every political subdivision is responsible for calculating their own caps, but the county auditors are the ones that are collecting the taxes and determining the mill rates. What is the remedy for a taxing district that does not calculate their caps correctly? And how is that fixed? Is it fixed in a future year, or is the county going to have to do like refunds? Do we know? Is that a question for the attorneys? I'm just thinking of all these scenarios out there for the remedies. If there's something, or who is policing the calculations if there is an entity that's doing that?
I will answer that question and then tell you that please ask it again when the attorneys are up here. But in my opinion, the bill is silent on that. There's nothing in the bill that stops a county auditor from assisting with or preparing cap calculations for every political subdivision, but it is not your responsibility. I understand why you maybe would want to. And I think for some of our really small cities and maybe new city auditors, new business managers, this is a lot. And they're maybe going to need some help. These are numbers that county auditors are familiar with working with and finding and getting and using for calculations. So I would guess in most counties that county auditors will be helping the other political subdivisions with those calculations. But the bill is silent on what happens if it's not done right or it's ignored. I would hate to find out at the next session what happens.
Thank you for the information, Linda. I have a few questions. The number that's used to calculate the base year, is it the net amount or the gross amount? We use different ones on the mill levy certification sheets, which do not include the homestead credit and veterans credit. And then on our abstract, it does include the homestead credit and veterans credit. So which dollar amount are we using?
If I'm not mistaken, on the maximum levy worksheets, the value does include the homestead and the veterans credit values. It might be the opposite. So whatever value you use to calculate that mill rate that's applied to all the values, that's the same value you use. So the answer is the value you use on your maximum levy worksheet, which includes the homestead and veterans credit value.
The values, but the dollar amount that we're using to calculate the cap, which amount do we use, from the mill levy sheet or from the abstract? Because they're different. Your mill levy sheet.
Yeah, so it's a good question. So which amount you use? I have to think about that. But I do think we'd use what's on the maximum levy worksheet because that's where the actual mill rate is calculated. That's where I'd get the number from.
But the number that they're going to pull off of the state's website is going to be from our abstract.
On the TLR, though, those numbers should match the tax levy reporting tool. Those numbers should match your maximum levy worksheets. I would say what we found is not everybody is probably reporting that correctly, but most 95% are, and the state tax department's really good about calling and saying something doesn't look right here. But yeah, it should be, the TLR should match your maximum levy worksheets for the most part.
My other question is farm to market is repealed and it'll end this year for everyone. We decided to, in 2024, still levy farm to market. So is that considered new even though we voted on it 2 years ago? Would that, our 20 mil county road instead of our 10 mil county road and 10 mil farm to market is what we'll be doing in 2025?
I'm not sure I'm following. I understand what you're saying about, you have a levy, so farm to market is a levy that expired. It was allowed, back in 2015, you could use it for 10 more years. It's one of the road levies for counties that's expiring. This is the last year you can use it. You did levy for it somewhere last year.
We levied.
So you're going to pull that number in either calculation, you're going to pull that number as a dollar you levied the previous year,
Correct.
and you'll have those dollars. If you're going to move that now to a different mill rate or mill levy number, you're going to move it to county road and bridge instead, you've got the dollars to work with.
Is the new 10 mills that's added to the county road and bridge subject to the cap?
If you didn't levy for them last year, it's the cap is based on the dollars levied the previous year. If it's a new 10 mil that you approved and you didn't use it last year, you're kind of out of luck.
So,
Unless your measure said effective tax year 25.
so last year we levied 10 mills in the county road to bridge. This year we have the authority to levy 20. Are
Correct.
we able to do that?
Yes. Because
So
you're going to
it's
move the
not-
10 mills you levied in farm to market to county road and bridge. So, yeah. Yep. They'll be in there. When you
Okay.
run your calculation, call me.
Okay.
I'll show you.
My other question is, we share a library with another county.
Yeah.
And we have an agreement that we both levy the same mills, no matter what it shakes out to be. So do we use our numbers collectively like we have in the past, or do we do them separately?
I would say just like a health district,
Mhm.
you'll run those valuations together. What's the budget dollars they need, and you will both use whatever the mill rate is.
Okay.
But that you will run. That's one of those ones that isn't going to apply countywide. It's not going to apply to entity-wide. So you're going to run a separate cap calculation on anything that isn't applied to all of the values in the county.
Okay. The 10 mills that we're allowed to hold for the emergency fund, that did not change.
If you look at the emergency fund, it is there are thresholds built within the levy limitation, and as long as you meet that threshold, and I can't remember what it is off the top of my head, you're fine. That's why it's not capped, because the idea is that you have an emergency, you deplete it, the emergency levy allows you to get those dollars back to where they need to be or what the law allows.
And if a township had previously levied to go over the 18 mills, does that stand, or do they need to revote this year, even though their meetings were held in
No.
March?
So if the township voted this last March, like March of 25,
Mhm.
to exceed 18 mills by another 18 mills,
Mhm.
that allowance would be considered new levy authority.
Since it was before.
So that would
okay.
be exempt.
And then, do they have 18 mills at a meeting? So I've had this question before from my townships. It states in the law, electors at the meeting. So some of our townships have 5 people at the meeting. That is fine, right? They don't have to have a majority of the people living in their township, just whoever is at the meeting.
That's
Okay.
my understanding. And I've got township guy nodding back there saying
Okay,
yes.
just clarifying. Thank you.
Hello, Sam. I have another township question. So, let's say typically most of my townships here, they try to hit that 18 mills max levy. Is there a limit on that this year? If they want to go ahead and hit that 18 mills again this year, like they did last year, do I have to take that 3% into consideration as well?
You're not going to take the 3% for townships into consideration. That is their job. And their electors approve at their annual meeting what they're going to levy. So every year, the annual meeting is essentially considered an election to set their levies. So I don't want to say they're exempt from the cap, but they kind of are.
All right, thank you.
Are we good?
Linda, I got some questions for you online. Are you ready for more?
Yeah.
All right. Let's see here. So, would finishing a previously unfinished basement and other interior modifications be considered new construction for growth?
That is a great question, and it is a tax director question, and I am not a tax director. So, Shelley, what would do you have Is finishing a basement, an unfinished basement, would that be considered under the, yeah. We'll write that one down and we'll get back because that's just not my area.
Okay, thank you. Then we have a few about ambulance districts, and I think it addresses the same question, but how do newly formed ambulance districts comply with this? For instance, if the voters previously approved 15 mills for an ambulance service, do we keep with the 15 mills previously approved?
That's a great question. So the way ambulance districts read is their voters can approve, no matter what the measure says, the century code says cannot exceed 15 mills. So depending on when they implement that, their first mill levy, when they form the ambulance district, that's going to set their base year in dollars for the cap, regardless of what that mill rate is calculated out to be. If it's 15 mills and their valuation goes up, it's kind of those dollars that those mills generated is what the cap will be based on, not the mill rate. And nobody is entitled to an automatic 15 mills, even if the vote said that. The only entity entitled to a mill rate, regardless of what happens with value, is the state medical center.
And then just the other question to that is, if you're forming a new ambulance district, do they fall under the levy exemption from caps?
The first year of implementing that ambulance district levy would be that first exemption falling under new or voter approved levy. Yeah, that would be exempt. You can put on whatever dollars they need to within the 15 mil or whatever their voters approved. We have some ambulance districts that aren't, their voters didn't approve full 15 mils. So whatever that is, that's your levy limitation for your ambulance district. You can put those full dollars on.
So just to clarify, there's a few questions on here, but just to make clear, any voter approved levies are okay that first year they're passed, but after that, they're subject to the cap.
Correct.
Okay. That's all of them online.
Nice.
Oh, sorry.
Good hustle, Steph.
Can you clarify what we have to turn into the counties by August 10th? You said not the preliminary budget, but a statement?
Just a notice of some kind, and I don't think it says it has to be emailed or whatever. You have to provide the county auditor in some form the date of your hearing, the location, the time, date, and location of the hearing, and where your preliminary budget can be reviewed. That's all you have to provide by August 10th.
I have a quick question about townships. So it says in here can opt out the cap for up to 4 taxable years. Does that mean they vote on it one time and can make that for 4 years, or do they vote at it every annual meeting for 1 year each time?
My understanding of the opt-out would be you vote on it once and it's good for 4 years. For up to 4 years. It doesn't have to be, it's not required, it's up for up to 4 years. So if you have a special project and you need to opt out for 2 years, whatever your vote language said.
Linda, we have a dissolution of a school coming in, and our problem is it's going to be coming in from 2 different counties. Is that going to be considered new growth, number 1? And number 2, where are we going to get that dollar amount? Who's going to give us that dollar amount for that money, for that land coming in from 2 different counties?
See me looking at Adam, making eye contact with Adam. That's a great question. I know there's a couple other school dissolutions. I have an idea in my head, but I don't know for factually that it's correct. So I think we should follow up with that afterwards. I'm assuming they add a taxable value, you have a taxable value, they levy dollars and you levy dollars, and you're going to combine that together, and that's your basis going forward.
It's going to be divided amongst like 7 other schools. So I mean, the number, like, I don't know how we're going to get those numbers when the land itself is being dissipated between different districts.
Well, I hope you have a good tax director, because your tax director will have every one of those parcels they'll have each one of those parcels in that original school that's being dissolved will have a code of which school district they belong to, and now they'll be split up to different schools. So your tax director is going to have to make those changes within your property tax system, and then your system should be able to calculate out the value for each, including the new value for each of those school districts. But that's a really good question, and I'd say something we probably want to walk through with you.
Quick. So we've had a lot of good discussion today, and it's clear